Our next presenter will be Professor Joseph McCary. He's Professor of International Economic Law and Professor of Financial Market Regulation at the Faculty of Law and the Tilburg Law and Economics Center. He is also a research associate with the European Corporate Governance Institute. And we'll have as a discussant Professor Ricardo Leal, who is a finance professor at the Federal University of Rio de Janeiro at the Copiad Institute. He has been a professor at Georgetown University, Nevada University, and a visiting professor at various other institutions. So welcome.
I'm delighted to be able to speak today at the inauguration of a new Law and Economics Center. We had one at Tilburg University, and we just had our 10th year celebration. And at that time, it's called TILAC. We also had an inspection to see whether or not we would qualify for a Center of Distinction. The preliminary evidence is that we will, but in fact, hopefully we'll find out that the confirming evidence when I return is that we have. So I wish you the very best luck on the inauguration of your center. 10 years was a long time for us. The first day, I think, will seem very nice to you. Well, we won't do that one. No, we'll do that. The confusion is that my colleague, Eric Vermeulen, it's a family matter that's pressing, and he's unable to present his paper today, so I'm filling in for him. He's very sorry he couldn't make it. Okay, this paper is on, same paper. Same paper. Yeah, its topic is on essentially secondary markets, building liquidity. And since I didn't write the paper that you'll comment on, I put the two papers together, one that I wrote with Eric and the other paper, so we have some continuity. Okay, so this paper looks at corporate governance, IPOs, and economic growth, but what we're looking at in particular is how to stimulate liquidity for purposes of young firms having the ability not only to go public later, but also to attract investors. So essentially, after the financial crisis, we've seen reduction in liquidity in secondary markets, and we're looking at two different ways to raise liquidity. One, in terms of attracting new types of investors to the market for, let's say, IPOs, and secondly, looking for investors in long-run sense of raising liquidity for investments in firms. So this is the second paper that I combined with the first paper that Eric would have presented. So at least in terms of bringing it home, I thought we would look at the local question about which markets or what type of markets and their segments matter with respect to attracting liquidity. And really there's two choices. One, to have essentially markets that are interested in reducing agency costs. So there's in fact corporate governance rules more or less reflected in the listing rules that have a concern for limiting agency costs. Those are essentially the segment that look for higher corporate governance quality for the firms that go public. And then there are the other markets, essentially that are not so concerned about this strict moral hazard problem, but effectively generating investor confidence and not worried about more or heightened standards of corporate governance. And what we've seen, in fact, at least in Brazil, the markets that are more interested in corporate governance-oriented so-called rules may not, in fact, attract the most liquidity. So the question we're going to ask after the so-called crisis is, what type of IPO rules or standards should we have for listing, as well as how to create liquidity for the firms that go or are not yet ready for IPO but want to attract long-term investors for their enterprises. So this is just justification. Now, interestingly, what I noticed is that this market, or at least the markets that we've looked at around the world, very few markets offer tax incentives for listings. And I found this actually very odd that a jurisdiction would emphasize that. Most don't. And you can see, at least around the world, that in fact only one appears to have tax incentives for listing. And obviously tax incentives for listing is probably not really needed. In fact, could be something to think about twice. So in any event, at least for stimulating investments for IPOs, tax policy maybe should be kept separate from attracting cash. So what this paper, and certainly the paper that will be discussed, looks at the question of what type of financial market do we want in terms of its regulation, in terms of listing standards. And if you look at it, at least a pre-bubble, that is the internet bubble, the regulatory period in the financial crisis, we see that in fact U.S. Listed companies, that is in terms of total listed companies, while declining of course due to the lack of commitment in the market, we at least see that the NASDAQ companies have maintained somewhat of an equilibrium compared to the AIM, which has effectively lost all market traction, which is in fact a jurisdiction that has had principle-based regulation versus Alternext, which has been actually increasing. So the real question is what type of stock listing rules are a proxy for the type of investor that wants to go to a market, okay? So in fact, do we want to have this type of rule-based regulated market with a higher standard versus a principle-based such as AIM and these other forms as an alternative? I think at least looking at some of the data, the market today is concerned with characteristics of older firms, not so interesting governance standards, that is to say one share, one vote is not so important for investors. Long-term investors have decided to be part of the solution in terms of floating the company, so we retain the venture capital interest in some of those flotations. They just don't jump out after 90 days. And we've seen that friends of friends are actually helping to float these type of companies. So the real question for us is, what's the way forward in terms of the style signal that we want to have and convey for the type of companies we form initially, and then later when the IPO question comes, what type of signal do we want to have with respect to the corporate charter and listing? That's the issue in this paper and also the earlier paper. Okay, so obviously Alternext is the answer in some respects. Certainly we know after 2007 the market had an exodus of companies, so that is the AIM did, but we see Alternext attracted more firms because of the very nature of the regulation. And we could see this divergence. I think one thing that's important in terms of the IPO story is in Europe from, let's say, 1999 to 2002, IPOs actually created premia. And it was the only market period where there was a premia. And that was in a secondary market where, in fact, most of the actual secondary markets were harmonized in terms of listing rules. But after the 2002 period up to 2007, there were absolutely no premia attached to those markets. And the interesting thing is, after 2007, we see this divergence between the type of markets. AIM, which was a winner in the period from 2002 to 2007, which effectively raced to the bottom in terms of listing standards and attracted Russian companies, Israeli companies, Chinese companies. But we all know it was a form of, bet that in fact some firms would make it and others wouldn't. And we could see that in fact having a bet that wasn't secured and relied on not effectively analyst ratings, but these sub-market analysts to provide liquidity would be a temporary phenomenon. Whereas Alternext, essentially with a number of admissions, the quality of the so-called underwriters in the firms continued. So if we then step back a second and see in terms of how we should understand the corporate life cycle, what we have now is a gap in funding. And the funding gap is extreme. Because in the past, we had this so-called liquidity that could actually be flowed through secondary markets in Europe and the United States. But with the crisis, actually before the crisis, we would see that the solution to more so-called liquidity would be corporate governance flexibility. And that's what we saw in Germany, so-called in the bust period after the IPO phenomenon. We saw that certainly with the AIM and other markets that would assume more liquidity through this type of listing. It's come to an end. Very few companies see that as an alternative today for a market list. And what we actually have are choices, which is essentially growing companies that have higher ratings, and ultimately in terms of how we actually want to grow the capital. So in fact, there's going to be very few companies today that will be able to go public. So in the data we looked at for this paper, we see companies are much older. In the 1999 to 2007 period, companies were actually quite young in Europe and the United States. The average age was 4 years. Now the average age is 8 to 10 years for companies going public in Europe. Actually less in the United States. So what we see clearly is that there'll be a funding gap for early age firms. So this is, say, the 4 to 6 year firms. And the IPO, because it's going to require a higher level of capitalization, more of a market commitment, and a long-term so-called valuation made at IPO, there's actually a harder screen than we saw earlier. So in this respect, we see this actual growth, or where the growth will come from, in terms of increasing the cash flow and revenue. Firms will not be able to go public as they went before on spec. You can't use a real options analysis to assume that the firm's rate of return on investment after 1 year will be based on no real cash flow. So firms today have had significant cash flow. They have real revenue, unlike the so-called market listing requirements for the AIM and other jurisdictions that you did need to have actual revenue. And the cash flow has to be discernible in such a way as that the investors themselves don't take it out of the equation at IPO, but actually reinvest. So the nice thing we're seeing, at least in terms of understanding the corporate life cycle, is that the early stage, middle stage will totally be sliced off from the late stage, and there'll be different types of bodies actually making investments. So in fact, the corporate life cycle, where the most proprietary, most interesting part, will no longer be where most firms can raise capital today. It's just going to be segregated off from essentially the corporate life cycle fundraising period. Now, the United States, we've tried to do something about it. Whether you like Obama or not, you can say that he's essentially tried to create jobs. We have this debate now in the United States about the Jobs Act and whether it's in fact producing any jobs. Now, it's very hard to know whether any jobs have been produced as a consequence, but certainly this act was signed. It's very unusual that any legislation's passed in the United States, so cheers for Obama. There's some substance to it, supposedly. I mean, if you hear Jack Coffey speak, this is something we should actually sign up for. So scale back certain governance and disclosure requirements for 5 years. Maybe that's a good thing if you think that lowering standards will attract more liquidity. Exemptions from requirements to hire an independent auditor. If you think that investors don't want to have a firm budget constraint, that's also a good idea. And then finally, in terms of phase-in periods for revised financial accounts, this seems to be the kind of level of disclosure that we might not prefer if we were a serious long-term investor. So in fact, the Jobs Act is seeming to revert to the earlier period where flexibility in listing rules supposedly would attract investors. Okay? Well, the evidence is still out for Obama on whether or not many firms have taken advantage. But I gave an exam recently, and I chose the Manchester United public listing. I think every probably law professor's done that. And would Manchester United be the kind of firm that you would think about for job creation? Well, maybe the Neville brothers or Ryan Giggs at 40. That's a big market for retired or near retired footballers. But in terms of the cash flow, I guess the Yankee deal will change the cash flow situation, but wasn't in the IPO, by the way, in terms of future business on line of business analysis. But nevertheless, Manchester United was able to use this strategic listing rules to create capital, I suppose, for themselves, and also perhaps have enough money to pay $80 million to buy Ronaldo. I'm not sure, but at least that was some of the cash was for transfers. Now, also in the United States, as a response to the change, we've not only had the Jobs Act, which has created these opportunistic IPOs, but we've also seen New York Stock Exchange Euronext have created a new entrepreneurial segment. And this entrepreneurial segment will have very much the same idea, which is to attract particular types of firms for IPO. And we've seen many of these so-called growth companies, and this is just a favorite one of my co-author, coming to this segment for the purposes of enforcing, there's a regulated market in the so-called entrepreneurial exchange to take advantage of essentially the better run, more articulated, and ultimately higher capitalized companies. So New York Stock Exchange Euronext, in the context of stimulating liquidity, will hope to actually bring into phase a new period for entrepreneurialism in the United States. Now, the evidence is still out here as well, whether new segments targeted to particular types of companies, i.e. entrepreneurial companies that are fast growth and have proven returns, will actually do the job in combination with the Jobs Act. Now, besides making regulatory initiatives, i.e. the Jobs Act, and new segments of the exchange, we might also want to look at the IPO environment itself. So in terms of time to IPO, we can see that, in fact, there's cycles even over the last 10, 12 years in terms of median time and also median so-called amounts raised. And we've seen, in fact, there's been a resurgence, but there needs to be actually quite an increase because we've been actually through the doldrums. So what types of companies have been going public where people have invested in? Well, in terms of the type of companies, we can see in terms of the characteristics, they're very different than the ISS risk metric best practices that would be recommended for firms to go public. So if we look at some of the so-called winners in the IPO tournament, we can see Groupon, Zynga, Facebook, Zillow, LinkedIn, Google. And one thing they have in common is that, in fact, they don't need to have the type of corporate boards that risk metrics would like us to see. That is to say, they have chairs and CEOs together. Fortunately, J.B. Dimson last week was able to win that against the terrible risk metrics guys. Ultimately, if you think about these parties who are attempting to bring companies public, they want to have enough power in their corporate board with people who can bring long-term relationships to the board, typically suppliers. So what we see on the boards that have gone public are a strong grip on power, combined CEO, CEO, chairman position, a board that is independent nominally, but in fact is dominated by investors as well as strategic investors. And ultimately, in terms of the new wave, we see that these, in fact, have been the most successful types with respect to raising liquidity. So maybe the playbook is changing with respect to the type of governance that we'd like to have for so-called firms going public. Now, the new wave, or we call the next wave, in terms of tech IPOs, and you can actually look in the lower right-hand corner, left-hand for you, 99 through 2000, and then the post-period, you can see in terms of the percentage of firms with multiple class shares, certainly changing. That reflects a little bit of divergence in terms of good practice from the better run companies, percentages with so-called profiles that would benefit dispersed shareholders, that is to say, before and after, all make sense with regard to companies that are going public that want to essentially bring in long-term investors. The idea is that growth companies want to ensure growth, and they want to have a responsible board that maintains growth. If growth stops, then this corporate governance structure is dissolved. And think of Apple as a case study. Once the Apple machinery started declining, the very first thing we saw was a very respected activist hedge fund asking for their money back, right? Share buyback, extraordinary dividend, and a change in the corporate constitution of the board. So in fact, we can think of this as rotation in terms of corporate governance. That is to say, if the firm is a life cycle, and we're calling these growth-based firms that investors prefer, we recognize that the hedge funds play a very important role, which is to detect when this model is actually declining in so-called probativeness or ability to make returns. And we can thank this, at least if we look at Steve Jobs, his resistance to US risk metrics type corporate governance, to create, in fact, a niche for this particular type of firm. Now, if you look at the liquidity ecosystem and you look at the number of IPOs European-wide versus US, we can actually see that European companies need to come to the United States effectively to risk to get higher returns, knowing that, in fact, the US market still gives premia. And in terms of, and certainly we can see this in terms of the amount raised, because the amount raised certainly in terms of other studies have reflected the attractiveness to investors is because premia is still in the market. European markets, over the last 12 years, absolutely zero premia attached to IPOs across segment. So in fact, the only thing we see now is a resurgence in so-called US IPOs. We also see an increase in the amounts due to a constant rate in terms of premia attached to those offerings. Who are the type of companies going public? Well, quite clearly we can see this sector. Biotech, certainly we'll see it in terms of pharmaceutical. We still have intranet, but clearly tech-based or related, telecommunications for consolidation, thank you. And ultimately we can see that these are the firms that, in terms of targeted IPO value, have the most lustful levels. We did a little study ourselves, so I just did a slice for today because it'd be useful to have a slice to see what's happened. We just took 70 companies after 11, 12, looked at the U.S. stock exchange, and essentially looked at, because I want to find out what Jack Coffey has to say about employees, so I counted the number, 90,000 for these IPOs. Looked at the age for the so-called period, so 70 companies, average age 10 years, oldest 21, and ultimately in terms of youngest just 12, we can see the split out, very similar to what I mentioned before, biotech, software, internet, and other. And in terms of the winners, well, okay, still predominantly losers, but the areas, LinkedIn and others in the period of 2011, predominant winners because of the governance structure. So in fact, most of the winners, I didn't slice this out, are the ones that had the governance structure I mentioned. The bad IPOs with concentrated ownership, long-run investors, and ultimately hedge funds making sure that the returns are kept at the appropriate level. And hedge funds are investing in these companies too, of course. Who are the biggest owners of Apple's shares? Hedge funds. They're the long-term investors. And we also looked at EU. Not so many positives, I must say, but yeah, we knew that. Most European companies wish not to list in London today, so there's been an absolute decline in the number of lists. And in terms of at least the companies that have made some money, I mean, this is, of course, the big story, bio in Europe. And it's the only segment that has actually maintained the kind of traction that we saw pre-crisis. In terms of age, 11 years, oldest 51, surprisingly. And there's a similar type of so-called breakup, except the subsidized sector, which is medical, the largest sector in Europe that subsidizes medical. And that has a multiplier effect, and we can see it in certainly the companies going public. All right, I think there's some differences. Obviously, trading volume, if you want to go and just think about liquidity, these large lists will have lots of volume because they become covered early by analysts, but also large funds wishing to take a slice. So Europe has very little trading volume on these IPOs, and this is also for just that year. But there's a real big difference in terms of stimulating trading volume itself. What we're interested in ultimately is what exchanges they go on. Alternext is the winner in Europe compared to the United States, but you can see that either go Alternext or the main market in the US. Hopefully the entrepreneurial market will do something for us. And the ecosystem, if we look at LinkedIn, I think an important thing in terms of stimulating liquidity is that all the new style companies I'm talking about go to investor conferences. So there's a playbook. If you're a fabulous company and you don't need to attract liquidity, you go to 2 investor conferences a year. If you're a poor company and you go IPO and your IPO's double dipping, you go to as many investor conferences as possible. And if your share price is declining, you go at a rapid rate. Now, I've looked at these investor conferences themselves. There's on average 30, 40 a year. And we can see by the breakdown of the different companies that have gone IPO, who in fact goes to these investor conferences at what rate. And certainly it's correlated with so-called share price and also turnover as well as increasing returns. So investor conferences are a nice so-called element variable to look at with respect to this. And finally, we can see who actually goes to these investor conferences in terms of biotech, clean tech. Clean tech obviously will go to a lot more of them in the United States because, I'll finish up, because clean tech lost its tax advantage last year. So they've got to raise money somewhere. Okay, trading volume is then the key. We can see that. Certainly analysts cover more conferences. And you know, I didn't put the slide in, but also it really helps the shorts. So we actually have a study in terms of the people who go to the conferences and the companies that get shorted. So the shorts are very concerned about the investor conferences because it gives them that one-to-one and other knowledge, helping them to figure out the good guys from the bad. And you know, Reg FD doesn't cover it. Okay? So ultimately, and this is just an example from the Blue Shirt Group in terms of the investor relations and the ability to effectively gain liquidity. Law firms just finally play a role in this as well. Finally, they're essentially helping to list companies and they form alliances. So we can see the companies in the U.S. doing that. So just to sum up quickly, the cycle's changed. The young IPO company, we have trading volume stimulated by investor conferences, law firms, and second markets in particular playing a role. And I think the key thing is this is not the area to go for, the so-called governance style concerns. If you really want to list companies, forget that. Don't worry about governance. Go on growth and just ignore risk metrics because they're not really interested in the most important things, which is liquidity. Thanks.
Okay. See if I can see anything. I'm going to make a few comments to relate the paper about the cycles and the particularly considering private equity with our beloved country. So I may be a little bit colorful or cynical, but that's it. So anyway, the article presents an issue which is the extension of the investment cycle from the pre-IPO private equity phase all the way to pre-IPO phases, early IPO, and then into IPO. So what led me to imagine what is this for us? What is the meaning of this paper for us in Brazil? So if you look at the need for exit opportunities, the authors claim that it's very important that you have some sort of early exit opportunity somewhere along the road because you can then preserve talent, you can preserve the entrepreneurs in the company. They may not be the controlling shareholders anymore, but they are the ones with the idea and so on. So anyway, it could be very important to preserve this kind of talent, to have some sort of a escape valve with some early liquidity opportunities along the way. And they provide a few examples such as second market and other examples in the Tel Aviv exchange, which is more of an early IPO, but of circumstances around the world in which this has been attempted or it's being attempted right now. So I was thinking, well, how would that be for us? So the person who opened the event said Brazil has over 200 law schools. So I always think Brazil is a country of, and then on behalf of our foreign guests here, is a country of cartórios and concursos. What does that mean? Cartórios, a literal translation is notary, but that doesn't mean anything that it means to an American. A notary guy in America is just a guy in the accounting office with a stamp. That's pretty much it. Here in this country, notaries are big businesses, large offices, big depository of documents. You don't do anything in this country without going to a notary office, because you have to prove that what you're saying is true, the documents that you have are true, the contracts that you have are legal and true, and so on, because nobody trusts anybody. So, and it's hard to go to courts later on to fight on something. That will take 20 years. So I shouldn't say that in a law school, but anyway. So you try preemptively to avoid the most problems you can, and notaries have this role, important role in this country. Besides that meaning, notary has a much more cartório, much more bigger meaning here. It means privileged interest groups who try to preserve their privileges the most they can. In Brazil, there is a lot of that. And it goes all the way from unions to businesses, from left to right. So there is a tremendous distrust of markets and business people. Then there is concursos. That's also a major reason for law schools to exist. Concursos are the public admissions, public service admission exams. This is a huge industry in this country. Lots of people spend their weekends in crammed rooms studying, taking classes for concursos. And being a lawyer is a good degree to have, because most concursos, lawyers can take the test. So these guys going to these law schools, they don't want to be lawyers. Most of them don't even pass the bar exam or never take it. They're looking into something else. They're looking to this reality of cartórios and concursos that it is our country. So our country is it's not flexible. Things are slow and locked and difficult and so on. So anyway, this is just to give you a kind of generic picture of the protected privileges of our country. Anyway, and then what is the Brazilian capital market? The Brazilian capital market is a big bank in Rio called the National Development Bank. That's about it. Of course, there's a stock exchange. I know there is a former president of the Securities Commission here. There is the private equity industry. We have the 4th largest mutual fund industry in the world, but 90% of it is non-equity. So our capital market, from time to time, it experiences some periods of some exuberance, like between 2004 and 2007, and then periods of quiet, maybe what it is right now. And it is interesting to notice that our exchange has as many listed companies as the exchanges in Vietnam and Mongolia. So I don't know what that means. So anyway, I've seen it. So in about 1/3 of the listed companies, they don't care. They're just there. I don't know why. Maria Elena probably knows why, but I don't know. They don't have enough liquidity and so on. So that makes me think, how in a country like this, in which you have this large development bank, that's the main provider of long-term financing, debt financing, you don't really need to care about corporate governance to obtain a lot of your financing. Ownership concentration is actually better than ownership dispersion, because if the government is my main financier, and in many ways my main purchase, a buyer of services and goods, what do I care about shareholders, capital markets, shareholders' rights, and so on? I just talk to the same guy, which is the government. And we have ideas that are the same ideas from the Gysle government in the 1970s, now floating around, looking for tax incentives for entry-level markets. These are old ideas. And then again, maybe taxes disturb us so much because we're so heavily taxed in companies. And it's so complex, the taxation. Brazilian companies spend so much time dealing with taxation that maybe that's why they want some tax breaks in doing that. But anyway, that's an old idea. So in a country like that, in a country that the government distrusts markets, distrusts businesses, tries to establish what business people return rates should be in privatization concessions and so on, is there room for a market, a kind of an early IPO market that is going to be successful? Or even going backwards more, is there room for some sort of a second market feature in which people trade stocks of non-public companies? Is the government going to allow that? Besides, we have a monopoly in the exchange side. We don't have competition among stock exchanges. There's just one that owns the custody and settlement company. So I've seen you too. So it makes me think that maybe we are not flexible enough. Our mentality is not trustworthy in terms of trust. Business has to be based on trust. Our government certainly doesn't trust business people. And I find it hard that these opportunities are going to be successful in Brazil. But I hope they are, because I find that the importance of early exit is tremendous. Our private equity industry has grown basically out of nothing into over 100 funds, private equity funds, in 2 decades maybe. So early exit is important. But still, how does the development bank interfere in all of this process in terms of early financing as well, and not stimulating that you have market exits? So the main kind of exit, we know that that's true elsewhere too, is just companies being sold to other companies or other investors, and not through IPOs. But that's fine, that's true everywhere, as long as you have a few IPOs that can stimulate the market. But you still have this small capital market with 400 and so companies. That didn't change the number. The capitalization doesn't grow in real terms since 2008. The number of IPOs per year is very small. So is there a climate in this country for these early exits or early IPO opportunities and creative type of markets in which, as you said, forget about corporate governance, you need more flexible things. But we are not a flexible people. Things are very, very, very tight and structured and determined and difficult. And you need a cartório, and you have people that took a concurso deciding things. And the country is slow. So I don't know if that would be feasible. But I enjoyed reading your paper very much because you raise a very important question. The issue of developing exchanges going back and not forth in terms of their requirements, and becoming more flexible and offering opportunities for these early exits. Okay, so I enjoyed that very much, and I think that's a very important issue that you should try. I just stress very much propositions that have tax advantages at their heart. The prime condition is to have a tax advantage. I've seen that. I was a kid in 70-something. Didn't work.